Welcome back. Thanks for staying with us. South African consumer inflation has slowed to 3.5% year on year in November from 3.6% in October. The latest data from Stats SA shows prices fell 0.1% month on month. The easing of inflation was driven by softer transport costs, particularly lower used vehicle and fuel prices. Now, transport inflation fell from 1.5% in October to just 0.7% last month. At the same time, annual inflation cooled in recreation, sport and culture, as well as information and communication, while 4 categories registered no change. Meanwhile, food inflation edged higher for the first time in 4 months, rising to 4.4% in November from 3.9% in October. For more, we bring in economist Johan, who's on standby. Thank you very much for your time. A very good afternoon to you. South African investors are on edge ahead of the new data. The rand was flat in early trade yesterday ahead of the release of figures that will perhaps shed some light on the country's economic outlook. What are your expectations?
Yes, actually, the inflation numbers were welcome. Slightly below my expectations. So I think that as consumers, we have seen a significant decline in inflation over the last few years. And while inflation is likely ticking up a little bit further over the next few months, it's nothing serious and close to the Reserve Bank's 3% inflation target. And as you say, the rand has actually been strengthening quite a bit in recent weeks. And the stronger rand plus a lower oil price presents some benefits for consumers in respect with lower fuel prices, lower petrol prices coming in January. So despite the fact that there's still some niggling negatives in the inflation numbers like very high meat prices, the prospects for inflation remains pretty okay. And inflation is likely to move in a path that could bring lower interest rates in 2026.
And as all of this happens, global markets are watching the U.S. Federal Reserve. What is there to look out for in that regard?
Yes, I think in the U.S., mixed employment numbers recently, but employment growth has slowed quite significantly in line with what the Fed has been fearing. While inflation is still high in the U.S., I think the Fed has shifted towards more worries about the real economy. So the labor market is taking the bigger portion of the Fed's attention. And I think they're willing to accept that inflation is remaining higher for longer. And they're more worried about the slowdown in the economy pressuring the consumer. So I think there's more interest rate cuts on the cards for the U.S. early in 2026 as well.
Last month, we heard Reserve Bank Governor Lesetja Kganyago announcing a 0.25 percentage point cut in the interest rate, bringing prime lending to 10.25%. He said inflationary pressures on non-core items like meat, vegetables and fuel were temporary. What have the recent outcomes revealed about those forecasts? Can we truly say that upward pressure is entirely gone?
No, it's not entirely gone. There's still significant food price pressures in the system, especially on meat prices, as we discussed, because of the foot and mouth disease overhang on red meat prices especially. But there's normally shorter-term cycles involved there. If we think back to late 2024, for instance, we had avian flu and we saw chicken prices moving up rapidly, as well as egg prices moved up to 30% year on year. Egg prices are now negative on a year-on-year basis, around minus 11%. So these cycles will tend to move in the right direction on meat prices as well. So I do expect easier food price changes into 2026 and food inflation probably a whole lot lower by the end of 2026. So yes, those trends are intact, I think. We probably need to be patient over the shorter term, the next few months, but then we should see easing food inflation towards the end of next year.
Johan, South Africa passed many tests this year, like the S&P's decision to upgrade the country's sovereign credit rating outlook. We heard President Cyril Ramaphosa talking quite a bit about such achievements at the G20 summit, but private investment hasn't really picked up much. Where does this place the sentiments of the investment community and business?
Yes, usually private sector investment lags a bit in terms of the growth cycle. Private sector want to see the improvements coming from policy change. They want to see actual economic growth picking up. And of course, if you run into constraints in terms of production capacity, then you need to invest more. And I think we're moving in the direction of somewhat better economic growth, the better outcomes in terms of investor perceptions, as you rightly say, the upgrade from S&P, the moving out of the grey listing status. So there's a bunch of potential positives that could drive the economy in a better direction next year. So better confidence, slightly better economic growth, and I think being a lagging indicator, private sector fixed investment will finally start to come to the party. But it's not going to be an immediate game changer. It will likely take some months into years, over the next few years, where we see private sector fixed investment joining government investment and public corporation investment. And then we'll see a more concerted economic cycle over the next few years.
What about the translation for jobs? Because, of course, job creation and employment is still a big factor. We're not seeing big jumps in job creation, although, you know, businesses are steadily impressed. I mean, I saw the sentiment at the B20 summit myself. Why do we not see a translation in terms of job creation?
Admittedly, there has been some job growth, very slow, but at least positive job growth. But what we need is sustained, stronger economic growth. 1 year of better growth doesn't help. 1% economic growth is too little. So we need sustained uptick in economic growth over a period of time. If we think back to the period 2004, 5, 6, 7, 8, when economic growth was more than 5% per year. It took a few years of that more than 5% growth per year before employment started picking up rapidly, before we saw a serious decline in the unemployment rate. So we're still heading in the right direction, yes, but it's not going to have an immediate strong impact on the unemployment rate. Plus, we have to factor in that as jobs start picking up, then those disillusioned job seekers finally come back into the labor market and only then start being counted as unemployed. So it takes some time before the unemployment rate actually starts going down, because it first starts going up a little bit as those disillusioned job seekers become part of the labor force again and get counted as unemployed. So it takes some time, unfortunately. But we need stronger economic growth on a more sustained basis. And we probably need a pickup in policy environment as well. More sustained, stronger policy change and policy implementation that has been lagging.
Very well. Thank you so much for speaking to us this afternoon. That was Chief Economist Johan Els from PSG Financial Services.